name is Elizabeth Hutchison. I am a senior manager at Shannon Associates. That was a wonderful introduction. We've been around for 75 years. When I practiced this presentation, I said excited a lot, so that's the key word to see if I've toned that down a little bit, but I'm really excited to be in front of you all, not just to share the exciting new arena of tax, which I realize for most of us that's not exciting, but for me it really is. I love what I do, but to go over some other key things. But we've been around for a long time. We're a key part of Kent. Thank you for having us, and let's dive in. Okay, so a quick note before we start. Normal caveats that any CPA will give you when presenting is that this is the presentation based on the rules we have now. Things change, we get clarification. There's now, I got a notification last night that it's official that the millionaire tax is on the ballot. So we'll see what happens, but for right now it's law, so I get to talk to you about it. It's really meant for general education. If you have questions, I encourage you to reach out to us. I have my colleague Eric Lee, who's a senior or a manager with us currently. He is our expert in the Washington capital gains tax, so now you can quiz him on that after this presentation. On top of that, there's just a lot going on, and so I don't want to spend too much time giving you the agenda. We're going to talk about a few little key updates to the payroll programs and B&O taxes, and then spend bulk of the time on millionaires tax. So I promise you'll know more. It'll make more sense. We'll kind of cut through a lot of what's out there and what's scaring people right now. Okay, and then I'll try not to blow past my 30 minutes so that we have plenty of time for questions. Okay, so next slide from the agenda. Yep. Okay, my chart didn't show up, but that's okay. You've seen enough charts today, we're good. So, couple key things. The paid family medical leave premiums, they've gone up, not surprising. Costs for employment, costs of keeping people supported while they're on leave have increased. Expect that to rise as well. The expanded job protection rules, it's a big shift going from 50 down to 60. The chart kind of showed you that change between 2025 and 2026, but it's even a larger change going to 2027, where the protection rules will apply to employers with 15 or more employees, and then 2028 and forward, you're going to be down to 8 employees, which actually covers more and more people in this room. I'm not going to go in the ins and outs of the requirements of those rules right now, but it's good for you to keep in the back of your mind that this is something that you should take care of from an HR standpoint and ensure that you're treating employees who need leave or other key things that it's being handled. There are rules and exemptions around economic hardships and other things if you need to lay an employee off, but big picture, that's been expanded and it's continuing to expand in the foreseeable future. Okay. Washington Cares holds steady. I was kind of curious to see if the ESD presentation would talk about this. The overall benefit is staying the same. The actual cost is still staying the same. It's actually exciting to have something that's consistent. I just want to share that with you. The unemployment insurance wage base went up. Once again, I wondered if the ESD statistician was going to share that with you all. Oh, sorry, go to the next slide. I'll be better about it the next one. But big picture, the change in cost and increase in the insurance premiums at a maximum is $344.88. So good news there that the overall change isn't extremely large, but that's the amount it could be at most for each employee. And given the economic data that's out there, we would anticipate this to continue to rise as well. Okay, going on to, yep, no, you're good. That one's good. Okay, so for very large employers, for 2026 through 2029, there is a significant bump or surcharge for employers. Essentially, there's a 0.5% surcharge. This is at the B&O tax level, our lovely excise tax we have here in Washington. It may not pertain to that many of us in the room, but I also like to note that it's temporary, so you grow that business and you hit that $250 million number, 2030, and you'll be set, okay? There is a permanent B&O tax rate increase to particular industries, which is manufacturing, retail, and wholesale. That goes into effect in 2027. So it's a great time now to step back and say, hey, if I'm gonna be impacted by this, let me look at my pricing, let me consider potential pricing increases of my vendors, and just be prepared for that to take place. Now, this isn't suddenly a huge jump for those who are unaware. It's going from 0.484% to 0.5%. However, in our businesses that have, large gross receipts and small margins, it can be very impactful. So just want to include that before we dive in. Okay, so let's go to where we're going to spend the bulk of our time today. Okay, there's a lot of words on this slide, but here's what's really important to note, okay? This bill, the Senate bill that signed into law that created the millionaire's tax on March 30th of this year, creates a personal income tax. And that really is the jarring piece of this that has set us up for a lot of conversations. This does start January 1st, 2028. You may hear out there that the payments aren't really due until April of 2029, but that's coming from a perspective that you're not expected to make estimated payments or anything until April of 2029 for the 2028 tax year. That gives us a certain time frame, right? A little less than a year and a half to really plan for those people that are actually going to be impacted. And you may not be hit with the millionaire tax in 2028, but if you're growing your business, maybe that's only 2030, 2032, right? There are reasons to start thinking about this now, whether you're at this level or not. We're also going to talk about the capital gains tax because they're very interrelated, and you're actually more likely to hit that threshold than this millionaire's tax. And breakdown very basically of the millionaire's tax is your taxable income above the $1 million standard deduction will be taxed at 9.9%. We will break down a calculation with real numbers. I promise you'll have something tangible when we're done to think through this. But the capital gains tax, you essentially would pay 7% tax for the first $1 million, so any dollar over the $278,000 exemption, that's where we're at now, and it adjusts about every 2 years, but you pay 7% on that for that first $1 million after that threshold, and then it's 9.9% after that. So you're gonna hear things that sound kind of parallel, similar rates, and that's because they're very interwoven. And that's where I'll make the statement that although we call the capital gains tax an excise tax, it really follows a similar idea of a personal income tax. So that's as political as I'm going to get in this speech, but that's an important thing to think about. Okay, so here are the things where I want to make it clear are exempt from the millionaire's tax, because I get tons of questions and concerns over a lot of information that's out there. Okay, if you sell your home, right, we were just talking about real estate. If you sell real estate, it is exempt from both the capital gains tax and the millionaire's tax. The reason that I flag this is there's a lot of discussion that the millionaire tax is an exit tax, and people will hear that term and kind of fill in gaps. I would say the real estate excise tax that you have to pay that's been around for a long time when you sell that real estate is more of an exit tax than this millionaire's tax or capital gains tax, okay? If we'll talk about moving later, but if you're thinking about moving and you're gonna sell that beautiful $8 million home on Mercer Island, Washington takes a cut. So I just wanna be clear where the lines are, because when clients find out how the tax works, they're less scared of it. They can approach it, they understand it, and they understand more of the cost of them making a big change or not. Believe it or not, I don't want anyone in this room to move because of the tax. I want you to all stay and continue to invest in this community. Okay. Another key factor here is long-term capital gains that fall below that $278,000 threshold I keep talking about. If your long-term capital gains are below that number, it doesn't get included in the millionaire's tax, as well as it's clearly excluded from the capital gains tax. So if you can time the sales of stock, sale of your business, maybe adjust for that, you actually can have income that's exempt from both buckets, okay? Then another big conversation that's come up. A lot of you have been told, hey, you should have an S Corp, you should have an LLC, you should have all of these pass-through structures. Well, there isn't a corporate income tax yet. And so a new conversation that we're having with clients is considering, well, Do you revoke that S election? Do you decide you're going to be an incorporated business and have a separate layer of tax? It doesn't work for everything. It's not tax efficient for everything. But if you don't want to pay that millionaire's tax, this is another avenue to consider, okay? There's also a lot we still don't know right now. And a big piece of that is, will it be repealed through a ballot measure? The polls out there previously that were done back when it originally passed say, hey, it probably won't be repealed. We don't know. There's also at least one more constitutional claim out there. Keep that in the back of your mind, as it might be there, it might not be. It's really good to still plan accordingly. And then most of our businesses pay B&O taxes, okay? The goal of the millionaire tax was not to have businesses that are already paying into the system necessarily have to pay this additional layer of tax. Well, if your business pays $1 million of B&O tax, do you get a full credit when you report your allocable share of that income on your return, or do you just get a smaller portion? The calculation I'm going to show you today is only that smaller portion. But if you look at the language and what's out there, the goal was really to give a dollar for dollar credit. You may actually have clients, or you yourselves as business owners may not have a tax bill if this is truly a dollar for dollar credit if you're already paying into the Washington system. So once again, it's important to note there might be some limitations, but until we know, we don't know. There's this last bullet point about PTE. Raise your hand if you know what PTE is. Just if anyone knows what it is. Thank you, Eric. I appreciate your honesty. So PTE came about when the Tax Cuts and Jobs Act came in and said you don't get to take your state and local tax deduction on your personal return. So this was where states said, hey, we want you to get a business deduction for these state taxes you're going to end up having to pay on your personal return as kind of a workaround. Federal government supported it. It's something you can do. There is a way to make that election under the current rules. It's very unclear. It's not something I would encourage anyone to do immediately. Thankfully, we don't have to immediately, but there might be a way for you to get a business deduction for these particular taxes, okay? So, little bit of relief, doesn't tell you much, but let's go on to the next slide and let's actually run through some scenarios. So you never know the size of numbers. I promise I tried to make this big, but I promise that this will be really helpful because ultimately the federal adjusted gross income that you'd see on your tax return is $10 million for all three of these people, okay? All three of them $10 million a piece, okay? The only real differences are between Joe and Jack, which are the last two columns, and one has short-term capital losses of 10 million and long-term capital gain of 10 million, and it's flipped for the other two. The reason that this is done is to kind of show how weird the tax actually works. But at the end of the day, we are starting with $10 million of adjusted gross income. The way that the rules are written, you start with that number from your federal tax return based on the January 1, 2026 tax laws. The reason I flag this is we don't have rolling conformity. So where that becomes important is if, let's say we get a brand new shiny tax bill and it changes how income is calculated for federal tax purposes. Washington is not requiring itself to match that after 1/1/2026. So that means that the new bill that came into play, OB3 as I lovingly call it, from 4th of July last year, will apply. So anything awesome or good, like the qualified small business stock exemption, it's in play. Doesn't mean Washington can't change its mind later, but it gives you a dividing line to know how they're gonna apply and calculate that number. Okay, so the only other key thing here that I think you really, really need to know is that they're all Washington residents, okay? So let's move on to a calculation with a lot of little numbers, but let me give you the big highlights here. Overall, they each had $10 million of adjusted gross income. We anticipate, going through this calculation and seeing them each have about $9 million of Washington taxable income. Well, the quirk in this calculation is that you add back all of your long-term capital gains or losses. No matter what they're from, you add them back, or essentially reverse the direction that they're going, okay? And then you only add back anything that isn't excluded, okay? So how this works and what can scare some people is if you're not following the calculation closely, you might be afraid that you're going to pay tax on the capital gains and on your millionaire's tax, but no, you actually get a credit. Ultimately, you get a credit for those taxes paid from the capital gains side first, which will often be larger in a situation where I'm showing you that they have $10 million of long-term capital gains, okay? Overall, what I like to explain to people is if somebody comes to you with $10 million of federal adjusted gross income and they know that they're gonna pay $700,000 or $800,000 of tax, right? You can kind of start to see that maybe they're gonna have a bill of close to 8% if they fall into this camp, right? It gives you an idea to calculate that number. However, if they have big fluctuations of income, or they're gonna go sell a business, which is likely where you would see a large transaction like this, the numbers can look significantly different. And knowing that the capital gains tax can actually trigger a higher tax rate is really important to understand as well. And also to kind of spell away or get away from the idea that this is a significant issue, especially if they pay a significant amount of B&O tax and if we get that dollar for dollar credit. So Jim's this first column and he's paying about $770,000 of millionaire's tax under this calculation, okay? That's what he would be essentially paying. Well, if he would get the full benefit of that B&O tax credit, his bill would be down to about $150,000, just rough numbers. So there is kind of a swing here for businesses that are already paying in. Okay, the last column is Jack, and Jack's the one that gets the worst situation here, where he had a $10 million long-term capital loss that's getting added back as that reversing step, but he doesn't really get a benefit for it because there's no long-term capital gain to consider after that point. It's all been removed. And so essentially, when I've been to other presentations, they like to explain that $10 million of federal adjusted gross income could lead to, a 17% or more tax from a Washington tax perspective, okay? Another key thing to highlight here, because I didn't tell you if any of these people are married or not, it doesn't matter. You only get $1 million as your exemption at this point. And so keeping that in mind, that's one of those things that I would like to have changed, because you could have two business owners and essentially you got a marriage penalty built in, okay? Okay. The next piece that I wanted to just highlight is non-resident, very quickly. So if you're a non-resident, you don't necessarily get out of this tax, right? Let's say that you moved over to Portland, Oregon, not saying any of you do that because there's a whole different income tax program there. But Washington would still argue that the business income, which for purposes of this, I'm saying all the business income is Washington source. Well, the hard part and the real only difference in this calculation from what you saw before is that $1 million exemption gets allocated down based on your proportion of Washington income to your total income. So if you think that you leave the state and maybe you have less than $1 million, maybe you have $990 of Washington source income, you're like, oh, I don't have to pay tax. Actually, when you do the calculation, there's a chance you still fall into this bucket, okay? So I just want to make that clear that that's one of the areas to think about. Now, the other side of this is, well, what if you decide to move? Let's go to Nevada, right? That's the hot spot to go right now for tax reasons, not just because it's hot. But if you move to Nevada, you essentially would still have this coming to you as pass-through income, right? When you take kind of a step back and say, well, if you're running a business in Washington, you're probably spending time in Washington. You've got 5 maximum days that you can work in Washington before they expect you to start allocating wages. Well, that's not just important for this particular person, the business owner. What about your highly paid employees that have decided they wanted to live in Nevada with you, and yet you might want them on site to do things physically in Washington? There's a lot to think about as an employer. There is not, at this point in time, a withholding regime that's expected, but there is discussion about it. So there might be some way that they calculate a need for withholding. And that could be another layer to this. Once again, you have to be a highly enough compensated employee. You don't know what else is on your employee's tax return. But I've spent a fair amount of time in Oregon where they have lots of fun local little taxes, and they just have you assume if your employee spends any time in Portland after a certain threshold, you're just going to withhold. So we'll see what comes from that. We've got some time. They still need to hire quite a few people to get this to work. But beyond showing you some numbers and walking you through this, let's talk about just some practical planning ideas quickly, okay? You're gonna see that the first bullet point is moving, which I said, once again, I'm not encouraging anyone to do that, and that doesn't necessarily fix the issue. But it can be practical to do so if you've got a transaction on the horizon, okay? The thing we learned from the capital gains tax is if you're not a resident, you don't have to pay the capital gains tax. So if you're concerned over that specific area, it can be really valuable for you to think ahead. We anticipate that Washington will be as spooky and scary as New York or California or many of the other high taxing states, that you should have a plan. You should document it. You should make it clear that you have not been around. You should expect them to want to look at calendars, especially in the year of sale. And so what I'm encouraging you to do is, if this is something you want to do for a strategic reason, beyond just taxes, to have a plan, okay? Got clients that are already talking about moving for various reasons. Some of them are already snowbirding 50% of the time anyway, so arguments can be made, okay? It's also a beautiful time to talk about a succession and estate planning, okay? If you're growing a great business, you've got people that you care about, whether they're key employees or family members, next of kin, consider bringing them in. Consider a long-term plan to pull some of the income out, you know, whether it's in a trust or other tools. Just be very mindful that you're giving a complete gift if you're doing it. If you're not giving a complete gift, Washington already has a mechanism for that in this rule. So when I talk about a complete gift, there are ways of structuring trusts that are lovely and complex and take a lot of time, and thankfully I'm not an attorney who has to do that. But the key piece of it is to know that you are relinquishing ownership of something. And that can be really hard for people to do. On top of that long-term planning, it's never bad to think of who's gonna step into your shoes next and have a plan. And so if this is what gets you into that mindset, great. It isn't purely just for taxes. As you're all probably aware, there is a heavy estate tax burden here in Washington, right? Used to be 35% for a very brief moment. Now, as of July 1, our maximum rate is only 20% again. Didn't know if you knew that, but that's partly what this bill was actually adjusting as well. Restructuring. So I already highlighted that, hey, I'm gonna incorporate my business. I don't get to have the same flexibility I had before, but now that tax bucket, especially if I'm not taking much in the way of distributions, maybe it's more tax efficient as a C Corp in general. I've got clients that are large dental practices that don't get the benefit of the qualified business income deduction. Their tax rate might actually be better in this structure. You just lose flexibility. So there's a lot to think about that goes beyond just tax. Corporate structures do have different rules than necessarily pass-through structures, okay? Now, timing is key, right? So whether you have the ability through an investment portfolio to harvest losses like we lovingly talk about at the end of the year, or if you're a business that makes significant capital expenditures before or at the end of the year, you can smooth out a lot of income. You can adjust things. You can look at it from a perspective of, hey, I'll get a better tax impact next year because I'm gonna stay below a threshold versus accelerating it to get a deduction this year, okay? When you have people that are working closely with you and having those conversations, they might help actually save you real tax dollars. So I encourage you to have those conversations, especially at the end of the year. But the real big thing about timing that we often don't think about is, if you are selling a business, have you ever considered an installment sale, which that can be through self-financing, especially if you are selling to the next generation, key employees, people you feel comfortable with. Well, you can slow down capital gains that way. You can't slow down ordinary income and other things, but there are ways to really structure things that make the most sense for you, for the buyer, and for the tax situation. We never want the tax part to lead the conversation, but it's really, really important to know you have lots of options. Okay. Second to last, we've got maximizing the exclusions and standard deduction. If you can fill up those buckets, why not? If you can slowly snip at the top of the peaks, why not? And so there are a lot of conversations to have around whether it's the timing items that I brought up or how you structure contracts. That can all be very valuable. But there is flexibility because we know the calculation starts with your federal adjusted gross income. We know where the numbers come from. No shock or surprise there. Okay, the biggest thing that I want to know is that your planning really should be flexible. We don't know where the final rules are truly going to land. We don't know what clarification we're going to get. We don't necessarily know even what Washington will look like in a couple years. And so I encourage all of you to not make choices that are focused on the tax, but more so for your overall personal financial goals. So it may be that you live in Washington for a number of years. You say, hey, I'm gonna sell this in 5 years. Maybe it's time for me to relocate where my sister lives in South Carolina. Why not, right? There can be reasons that makes sense. But it's important to know what the rules are. And once you have enough time to dig in, I think they're a whole lot less scary, okay? Okay. I tend to go really fast when I'm speaking, and I skip a lot of the beautiful things I want to tell you, so feel free. I want to give space for questions, which I think I did. But yeah, go ahead. Will you go to the second to last slide? Okay, those are just the planning ideas. Okay, go ahead.
How does rental and investment properties figure into capital gains deductions?
Yeah, so the actual rental income that you get each year isn't considered capital gain, but it would be considered in your millionaire tax base, okay? But it's separate. When you go to sell the property, right, we talked about it being exempt. So really from a capital gains tax perspective, it's not an issue. Yep. Yeah, no problem. Okay. I know this is riveting stuff. Thank you for not falling asleep, mostly. Okay. Go ahead.
It may be riveting, but you've made it very interesting.
Oh, thank you. Thank you. That's very nice. Now, there are tax people that love doing this stuff, and Eric and I are both those people. Sorry, Eric, I'm going to keep calling you out because I can. But you know, I have clients that get into it and they're excited to hear code sections, and that's actually weird for me to face. So I don't expect you to be that way. Totally get it. I'm a normal person too. I didn't tell you my fun fact. I met my husband at the University of Washington. We were both in the Husky Marching Band, and we got to do the preseason for the Seattle Sounders when they were becoming MLS. We did parades and stuff to promote that. So I count that because I was paid minimum wage to play my instrument. I'm a professional musician. So there you go, my one fun fact for you today. But yeah, no problem. Well, please reach out to us. I know Julia spends a lot of time a part of this group, and I know Eric and I just would love to always share more. So if you have questions, we have business cards, and then also you can absolutely reach out to us through Julia, who is part of the chamber. Okay, awesome.